The world of investing looks bright from the outside. People see screens full of green arrows, news about sudden riches, and stories of success. But behind all this noise lies something deeper, something quieter, something that decides who wins and who loses. It is not about what you buy. It is about how you think. The greatest investors in history were not magicians. They were thinkers. They did not try to predict the future. They tried to understand the present with calm minds. Every investor enters the market with dreams of freedom. Freedom from worry. Freedom from limits. But very few find that freedom because they search for answers in the wrong place. They look at charts, headlines, and rumors. They forget to look within. The real battle of investing is not fought in the market. It is fought in the mind. Your thoughts, beliefs, and emotions shape your results more than any company or stock ever will. The difference between success and failure is not intelligence. It is rationality. Rationality is not cold or mechanical. It is clarity. It is the art of seeing things as they are, not as you wish them to be. This book is not a list of stocks or strategies. It is a guide for your mind. It teaches you how to build mental strength, emotional balance, and logical discipline. You will not find shortcuts here. You will find principles that last a lifetime. Each chapter opens a new window into the thinking patterns that shape a rational investor, from understanding emotions to mastering patience, from learning discipline to embracing reflection. These lessons will help you see the market not as a game of chance, but as a field of wisdom. The goal is simple: to help you think, not react, to help you observe, not obey, and to help you become the kind of investor who remains calm when the world panics. So before we begin this journey, take a breath. Forget the noise around you, forget the fear of missing out, and prepare to enter the quiet world of logic, patience, and awareness. Because in the end, your greatest investment is not your portfolio, it is your mind. And that journey begins now. Let us step into the first chapter. Chapter 1. The Mind of a Rational Investor. The first step toward becoming a rational investor is learning how to think clearly when everything around you is uncertain. The market is like a mirror. It reflects not only prices and profits, but also your emotions, hopes, and fears. To master investing, you must first master yourself. Most people enter the market chasing results. They want fast success. They believe the next big tip or secret formula will change their life. But a rational investor does not chase. He observes. He studies. He waits. He knows that thinking is the real edge. Rational thinking begins with awareness. Awareness of how the mind reacts under stress. Awareness of how emotions influence judgment. When the market rises, greed whispers, telling you that you are a genius. When it falls, fear shouts, making you believe you are a fool. Both voices are illusions. A rational investor listens to neither. He trusts logic more than mood. The human mind is a strange place. It loves stories more than facts. It seeks comfort more than truth. But the market rewards truth, not comfort. It punishes illusions dressed as confidence. That is why rational investors train themselves to question everything. They ask simple but powerful questions. What is real here? What is emotion and what is evidence? Where am I assuming too much? Every decision starts with curiosity and ends with clarity. A rational investor understands that the market is not his enemy. It is his teacher. Every rise and every fall carries a lesson. When prices crash, the crowd feels pain. The rational mind feels opportunity. When prices rise, the crowd feels excitement. The rational mind feels caution. This balance of emotion and reason is what separates thinkers from gamblers. To think rationally is to slow down. When others rush to buy, you pause to ask why. When others panic to sell, you pause again to ask why. The world moves fast, but wisdom moves slow. You learn to delay reaction until your thoughts settle. You wait until noise turns into understanding. This calm space between impulse and action is where all great decisions are born. A rational investor is not emotionless. He feels fear and greed like everyone else. But he does not let them drive the car. He lets them sit in the back seat while logic takes the wheel. He knows that emotions can inform, but never decide. Every thought in the market is a test of discipline. The news will try to shake you. The opinions of others will try to pull you in many directions. But clarity comes only when you trust your own process. Thinking for yourself is not arrogance, it is survival. Rational investors accept that uncertainty is permanent. No one can predict the next year or even the next day, but they do not need to. They play a different game. Instead of guessing the future, they prepare for it. They build habits of calm, patience, and critical thought. These habits become invisible shields against panic. Over time, this mindset creates strength that money alone cannot buy. It builds the quiet confidence that allows you to stand still when others run. It gives you peace in chaos and clarity in confusion. And slowly, it changes not only how you invest, but how you live. Because being rational is not just about finance. It is about how you see the world. It is about learning to separate signal from noise, fact from feeling, and truth from trend. When you learn that, every part of life becomes an investment in wisdom. And as you walk this path, remember this simple truth. You cannot control the market. You can only control your mind. The stronger your mind becomes, the more freedom you gain from uncertainty. That is the foundation of everything that follows. In the next chapter, we will explore the power of thinking slow. Because before you can think rationally, you must learn how to slow down your thoughts and master the space between reaction and reason. Chapter 2. The Power of Thinking Slow. In the world of investing, speed looks attractive. Everyone wants quick results, instant profits, and fast decisions. But what looks fast in the market is often just chaos in disguise. The rational investor learns that real speed begins with slow thinking. To think slow means to pause before reacting. It means allowing your mind to breathe before you choose. It is not about being lazy. It is about being deliberate. The slower you think, the clearer your decisions become. Most people believe success in the market comes from quick action. But quick action without understanding is only movement, not progress. A rational investor understands that clarity comes from silence, not from noise. He observes before he acts. He studies before he trades. He waits until reason replaces impulse. Thinking slow is not natural for the human mind. We are wired for survival. When danger appears, we react fast. That instinct helped our ancestors escape wild animals. But in the market, that same instinct becomes poison. When prices fall sharply, the brain feels fear and wants to run. When prices rise quickly, the brain feels excitement and wants to chase. Both reactions are fast, both are emotional, and both destroy rational judgment. To think slow is to fight this ancient programming. It is to remind yourself that the market is not a jungle. It is a place of patience. Here, survival depends on calm observation, not quick reaction. The rational investor trains his mind like a monk trains his breath. He learns to stay still while the world moves around him. Slow thinking builds distance between thought and action. That distance is your safety. It gives you time to question your emotions before they control you. It helps you see patterns others miss. It allows logic to speak while the crowd screams. This habit of slowing down is not just mental discipline. It is emotional intelligence. When you think slow, you begin to notice small details. You see how excitement hides in headlines. You sense how panic spreads through news feeds. You realize that behind every market movement lies a wave of human emotion. By slowing down, you rise above it. You start to see things as they are, not as they feel. Many great investors have practiced this art of slow thought. They do not rush to make decisions. They read deeply. They reflect before acting. They understand that missing one opportunity is better than losing peace of mind. They know that wealth grows through patience, not through speed. Thinking slow does not mean missing chances. It means recognizing which chances are real. It teaches you that sometimes the best action is no action at all. It reminds you that time can be your ally when you stop fighting it. Every time you pause before making a choice, You strengthen your mind. You build the habit of awareness. You give space for logic to lead emotion. That space is where wisdom lives. That space is where rational investors make their best decisions. So the next time you feel pressure to act fast, breathe. Ask yourself one question. Am I reacting or am I reasoning? That single pause can change your entire financial future. The world celebrates speed. But in the silent mind of a rational investor, time slows down. Thoughts become clearer. Decisions become wiser. And patience becomes profit. Thinking slow is not a weakness. It is your strongest defense against emotional mistakes. Because when you learn to slow your mind, you start to control your world. And that control opens the door to the next truth. If slow thinking is the foundation, then clarity about value is the structure built upon it. In the next chapter, we will explore the difference between value and price. Because only when you think slow can you truly see what something is worth. Chapter 3. The difference between value and price. In the market, people often confuse price with value. Price is what you pay today. Value is what you truly receive in return. The rational investor knows the difference. Understanding this difference is the key to long-term success. The world is obsessed with price. Every day, screens flash numbers. Red numbers make people panic. Green numbers make people celebrate. But numbers alone tell only a part of the story. They are surface reflections, not the deep truth. Value is silent. It does not shout. It hides behind management, assets, potential, and efficiency. It is measured by fundamentals, not by fear or hype. A rational investor learns to look beyond the noise. He studies the company, not the chart. He studies the business, not the market rumor. Price can be high while value is low. Price can be low while value is high. This is the paradox the market offers every day. The crowd chases price because it is visible. The rational mind chases value because it is real. Learning to see value requires patience. It requires discipline. It requires thinking slow. As we learned in the previous chapter, every investment decision must start with the question, what is this worth? Not what is the market saying, not what others think, but what is the intrinsic value of this asset or business? When you understand value, price becomes a tool, not a trap. History shows countless examples of people who lost money chasing price. They bought popular stocks at the peak of hype. They sold undervalued assets out of fear. They reacted to headlines, not reality. The rational investor does the opposite. He buys when value exceeds price. He waits when price exceeds value. This simple principle separates those who build wealth from those who chase it. Understanding value is not complicated, but it is often uncomfortable. It forces you to ignore the crowd. It forces you to resist trends. It forces you to trust your analysis rather than your emotions. But discomfort is a small price to pay for clarity. Value is like a hidden treasure. Price is like the map people stare at without thinking. If you focus only on the map, you will never find the treasure. If you study the land, understand the markers, and explore patiently, the treasure reveals itself. The rational investor sees the market as a place of opportunity. Every mispriced asset is a potential gain. Every overpriced asset is a risk to avoid. This awareness changes how you act, how you wait, and how you plan. By focusing on value, you shift the balance from guessing to reasoning. You move from reacting to understanding. You no longer chase fleeting trends. You begin to invest in reality, not illusion. Remember that value is not fixed. It grows or shrinks over time based on business fundamentals, management quality, and economic context. Price fluctuates daily based on fear, excitement, and speculation. The rational investor watches both, but gives priority to the silent, steady measure of value. In this pursuit, patience and discipline are your allies. You buy when others panic. You wait when others celebrate. And in the quiet space between price and value, opportunity thrives. This understanding of value forms the foundation for the next step. Once you see value clearly, mental models and frameworks help you use that knowledge wisely. In the next chapter, we will explore the mental models of wealth. These tools allow the rational investor to transform insight into intelligent action. Chapter 4. The Mental Models of Wealth. Investing is not just about money. It is about the way you think. The rational investor knows that mental models are the tools that shape decisions. A mental model is a lens through which you see the world. The sharper your lens, the clearer your vision. Most people rely on instinct or luck. They act impulsively. They follow tips and trends without understanding. The rational investor does not. He builds frameworks in his mind to evaluate every opportunity. These frameworks are mental models. They are simple, practical, and powerful. One of the most important models is compounding. Compounding is the magic of growth over time. Small, consistent gains turn into large results. It rewards patience and punishes haste. Another model is the margin of safety. It is the cushion between risk and ruin. It protects you when your assumptions fail. Without these mental tools, decisions become guesswork. Opportunity cost is another vital model. Every choice has an alternative. Every action has a cost. A rational investor asks not only what he gains, but also what he sacrifices. This awareness shapes smarter decisions. It prevents wasted effort and misplaced confidence. A rational mind also uses the model of probabilistic thinking. No one can predict the future with certainty, but you can estimate probabilities. You can weigh risks against potential rewards. This way, decisions are guided by reason, not hope. Models are not just numbers. They are habits of thought. They teach you how to see patterns, avoid mistakes, and understand complex systems. They give structure to chaos. They turn uncertainty into manageable choices. Consider another model, the circle of competence. You do not need to know everything. You only need to know what you understand deeply. By focusing on your strengths, you reduce mistakes and increase confidence. A rational investor recognizes his limits and works within them. This honesty is a mental model in itself. It is important to note that mental models are interconnected. One supports the other. Compounding works best with patience. Probability thinking works best with discipline. Value analysis works best with independent thought. Together, they form a web of reasoning that strengthens every decision. The power of mental models is that they guide your mind when emotions rise. When fear or greed appears, the models act as a compass. They remind you of reality. They show you what matters and what is illusion. A mind equipped with these tools is calm, even in chaos. It sees opportunity where others see risk. Using mental models also creates confidence without arrogance. You act with knowledge, not impulse. You do not need to follow the crowd. You do not need to chase trends. Your decisions are rooted in clarity and understanding. Mental models are not rigid rules. They are flexible frameworks. They evolve as your knowledge grows. The more models you understand, the better your thinking becomes. And the better your thinking, the more likely you are to succeed in the long run. By building these frameworks, the rational investor transforms raw information into wisdom. He moves from reacting to reasoning. He moves from guessing to understanding. And in this shift, money becomes a byproduct of clarity, not a goal chased blindly. This leads naturally to the next lesson. Even with mental models, human desires can interfere. Discipline is required to ensure that logic controls action, not emotion. In the next chapter, we will explore discipline over desire and how it keeps rational investors on the right path. Chapter 5. Discipline over desire. Desire is a powerful force. It pushes people to act quickly, to chase gains, and to ignore caution. In the market, desire can be dangerous. It tempts investors to buy what is popular, not what is rational. It makes them impatient. It makes them restless. And it often leads to mistakes that are hard to undo. Discipline, on the other hand, is the antidote to desire. It is the quiet strength that allows the rational investor to pause and think. It is what separates those who build wealth from those who chase it. Discipline is not about restriction. It is about freedom. It frees the mind from emotion. It frees the investor from the pressure of the crowd. The market constantly tests discipline. Prices fluctuate. News flashes. Opinions roar from every corner. The uninformed mind reacts. The disciplined mind reflects. It asks, is this opportunity real or is it illusion? Does this decision align with my understanding and strategy? Or am I acting because I want immediate gratification? A rational investor knows that not every opportunity is worth taking. He knows that sometimes the best action is inaction. Discipline teaches him to wait for the right moment, to act when probability favors him, to resist the urge to follow the herd. Desire can create shortcuts that appear tempting. The promise of fast wealth, the fear of missing out, or the excitement of trending assets can cloud judgment. A rational mind sees through these illusions. It knows that shortcuts often lead to mistakes. Discipline ensures that the process is followed, even when it feels slow or inconvenient. This does not mean ignoring ambition. A rational investor can have goals and dreams. But ambition is controlled by method. Desire is controlled by logic. Without discipline, ambition becomes greed. Without ambition, discipline becomes stagnation. The balance of the two is the hallmark of rational investing. Discipline also protects during losses. When a stock falls or an investment disappoints, emotions surge. Fear, anger, and regret want to drive decisions. The disciplined mind listens, but does not obey. It analyzes, recalculates, and waits for clarity. Impulse sells are avoided. Rational adjustments are embraced. Every disciplined action compounds over time. Small, consistent decisions, guided by logic rather than desire, create long-term advantage. The investor who remains patient, who follows process, and who respects discipline builds a foundation that cannot be shaken by temporary market swings. Discipline is also about preparation. It is about creating rules in advance and following them without exception. It is deciding what you will do when fear or excitement appears. It is committing to a process that respects probability, value, and patience. The rational investor treats rules as allies, not obstacles. Desire is loud. It demands attention and immediate satisfaction. Discipline is quiet. It works behind the scenes, shaping decisions and outcomes. Most people ignore it because it feels slow or uneventful. But over years, it is discipline, not desire, that determines success. The mind trained in discipline develops clarity. It sees patterns without being seduced by emotion. It makes choices aligned with long-term goals. It avoids mistakes that come from acting too quickly or following the crowd blindly. In the next chapter, we will explore the emotion trap. Even the most disciplined investor faces fear and greed. Understanding these traps and how they manipulate thought is essential to maintaining rationality and protecting wealth. Chapter 6. The Emotion Trap. Fear and greed are the oldest enemies of rational thinking. They are invisible forces that shape decisions without notice. Every investor faces them. Every market move triggers them. The difference between success and failure is how you respond to these emotions. Fear appears when prices fall. It whispers that loss is permanent, that ruin is near. It urges you to sell quickly, to escape pain. Greed appears when prices rise. It shouts that opportunity is endless, that you cannot miss the next gain. It urges you to chase, to buy at highs, and to ignore caution. The market magnifies these emotions. It creates cycles of panic and euphoria. Most people follow the crowd. They react to what others feel, not what reality shows. This is the emotion trap. It turns even intelligent investors into impulsive decision makers. The rational investor does not deny emotions. He does not pretend to be emotionless. Emotions are natural. They are signals, not orders. The key is observation. The rational mind watches fear and greed like a scientist studies a phenomenon. It asks, what is this feeling trying to tell me? Is it based on facts or on illusion? Emotions are amplified by stories. The market is full of narratives that heighten fear or excite greed. Headlines scream losses or celebrate gains. Social pressure grows louder. A rational mind recognizes these narratives as noise. It separates signal from story. It focuses on the underlying facts. Another trap is overconfidence. Greed and past success feed it. It makes you believe you are smarter than the market. It encourages risky bets. It clouds judgment. The rational investor tempers confidence with humility. He respects the power of chance and the limits of knowledge. Fear can also become paralysis. It stops action when opportunity is real. Greed can become recklessness. It forces action when caution is needed. Both extremes are dangerous. The rational mind maintains balance. It neither rushes nor freezes. It acts only when reason aligns with opportunity. Discipline and slow thinking, learned in previous chapters, are essential defenses. They create space between emotion and action. This space allows the mind to analyze, reflect, and decide. Without it, the emotion trap tightens its grip. With it, the investor sees clearly, even in chaos. Rational investors also prepare for emotional attacks before they happen. They set rules. They know when to sell or buy based on logic, not feelings. They use checklists and mental models to guide decisions. Preparation transforms emotional impulses into disciplined action. Every market cycle is a test. When fear rises, most run. When greed rises, most chase. The rational mind observes and evaluates. It understands that emotion is temporary. Logic and patience are permanent. Emotions are powerful, but they are not destiny. You can acknowledge them without being controlled by them. You can use their signal to improve judgment rather than impair it. This awareness is not natural for most people. It must be trained through practice, reflection, and self-observation. By mastering the emotion trap, the rational investor gains freedom. Freedom from panic. Freedom from impulsive greed. Freedom to act calmly in moments that overwhelm others. It is this freedom that makes rational decisions possible. The next step in this journey is understanding the circle of competence. Even with discipline and emotional control, one can fail if investing outside their knowledge. Knowing your limits ensures that rational thinking is applied where it matters most. Chapter 7. The Circle of Competence. No investor can know everything. The world is too vast, the markets too complex, and the unknown too powerful. The rational investor accepts this reality. He knows that true strength comes not from pretending to know it all, but from understanding what he does know. This understanding defines the circle of competence. The circle of competence is the area where your knowledge is deep and reliable. Within this circle, you can evaluate opportunities with confidence. You can judge risk with accuracy. You can act without being misled by emotion or noise. Outside this circle, uncertainty grows. Risk increases. Mistakes become more likely. Most investors ignore their circle. They are drawn by popularity, hype, or the desire to impress. They invest in industries they do not understand, in businesses whose numbers confuse them, in trends they cannot explain. When things go wrong, they blame the market. But the market is not the problem. The problem is acting outside competence. The rational investor does the opposite. He identifies his strengths. He studies the areas he understands. He invests only where his knowledge gives him an advantage. He says no to opportunities that fall outside his circle, even if they seem exciting. This is not fear. It is wisdom. The circle grows over time. As knowledge and experience expand, you can widen your area of competence. Learning becomes a deliberate practice. Reading, observing, and analyzing strengthen your ability to evaluate more complex opportunities. But this expansion is controlled. It does not mean chasing every new trend or idea. It means adding new ground carefully and deliberately. Discipline complements competence. Even when an opportunity falls within your circle, patience and logic determine if it is worth acting upon. Your circle gives you the tools. Discipline and mental models guide how you use them. Together, they reduce mistakes and enhance long-term performance. The circle of competence also protects the mind from arrogance. It reminds you of limits. It forces humility. Even highly successful investors understand this. Confidence without recognition of limits leads to reckless decisions. Knowledge of limits leads to calm, rational action. A rational investor observes his circle continuously. He identifies areas of ignorance and avoids them. He tests assumptions within areas of knowledge. He strengthens the foundation rather than chasing distant, uncertain horizons. This self-awareness is as important as technical skill or financial insight. Understanding competence is also about risk management. Investing in areas you do not understand multiplies unseen risks. Even the best strategy fails when applied to unknown territories. The rational investor minimizes such risk by acting only where judgment is reliable. The crowd often mistakes confidence for knowledge. It celebrates bold moves in unfamiliar industries. It praises risk-taking without understanding. The rational investor sees beyond this illusion. He knows that steady, informed choices outperform spectacular but uninformed bets. Your circle of competence is personal. It is defined by your experience, study, and observation. No one else can tell you where it lies. You discover it through reflection and honest assessment. Investing outside it is like walking blind. Investing inside it is like walking with a map. Ultimately, the circle of competence is not just a boundary. It is a framework for freedom. It allows you to act decisively, invest intelligently, and avoid unnecessary errors. It transforms uncertainty into manageable opportunity. The next principle builds on this foundation. Even within your circle, the world is unpredictable. That is why every rational investor requires a margin of safety. It is the cushion that protects knowledge from mistakes and uncertainty. Chapter 8. The Margin of Safety. Even within your circle of competence, uncertainty exists. No knowledge is perfect. No analysis is complete. The future is unpredictable. Markets fluctuate. Businesses change. Mistakes happen. This is why the rational investor relies on the margin of safety. The margin of safety is a cushion. It is the gap between the price you pay and the intrinsic value you perceive. It allows room for error. It protects against the unexpected. It is a principle that turns investing from speculation into rational decision-making. Many investors ignore this concept. They buy assets at prices that reflect their highest expectations. They assume everything will go perfectly. They forget that markets are volatile and assumptions can be wrong. When reality fails to meet expectation, losses follow. The margin of safety is designed to prevent this. Imagine a business worth $100. If you buy it at $80, you create a buffer. If challenges arise, your investment has a cushion. If you buy it at $99, there is little room for error. The margin of safety is not about greed. It is about prudence. It is a form of self-protection. This principle requires discipline. It requires patience. It requires humility. You cannot always buy at the perfect price. You must wait for opportunities that align with your analysis. This is why many investors feel frustration. The rational mind embraces it. Frustration is a signal to stay patient, not to act impulsively. The margin of safety also teaches the importance of flexibility. Even within your circle of competence, situations change. Businesses may falter, economies may shift, unexpected events can impact your assumptions. By maintaining a cushion, you reduce the risk of permanent loss. Risk and uncertainty are not enemies. They are part of the system. The margin of safety allows you to participate without being harmed. It is a principle that encourages courage when others fear, and restraint when others rush. Many great investors emphasize this concept. They do not predict perfectly. They do not assume they are always right. Instead, they focus on creating conditions where mistakes do not destroy capital. This mindset transforms investing from gambling into a disciplined process. The margin of safety is both practical and psychological. It reduces anxiety because you know you have a cushion. It allows rational thinking to guide decisions rather than emotion. It prevents panic selling and emotional buying. It reinforces the lessons of slow thinking, discipline, and competence learned in previous chapters. This principle also shapes long-term thinking. You can hold positions through market volatility when a margin exists. You are not forced to react to every swing. You gain the freedom to follow reason rather than emotion. A rational investor never sacrifices safety for short-term gain. The market may tempt you with fast profits. The crowd may celebrate risky bets. The rational mind resists. It knows that protection is more important than excitement. Over time, consistently applying the margin of safety compounds advantages. It reduces mistakes, preserves capital, and creates opportunity for thoughtful investments. It is the shield that protects reason from chance. It is the foundation for sustainable wealth. In the next chapter, we will explore how time becomes the greatest ally in investing. Even with competence, discipline, and a margin of safety, the true power of investing is revealed through patience and the compounding effect over years. Chapter 9. Time is the greatest investor. Time is often underestimated in investing. People focus on instant profits, short-term trends, and rapid success. But true wealth is created slowly. It grows quietly, steadily, and almost invisibly. Time is the greatest ally of the rational investor. Compounding is the secret behind this power. Small gains, repeated consistently over years, turn into extraordinary results. Interest, reinvested profits, and patient decisions accumulate like a snowball rolling down a hill. The longer it rolls, the larger it becomes. But to benefit, you must start early and resist the temptation to interfere with each fluctuation. The market is full of distractions. Daily price movements feel urgent. News and opinions scream for attention. People worry about every rise and fall. The rational investor sees the bigger picture. He knows that most short-term noise is irrelevant. Time allows value to be realized, even if the crowd cannot see it today. Patience is a form of power. It allows decisions to mature. It gives the mind the space to observe patterns without reacting impulsively. It protects against emotion-driven mistakes. By letting time work, the rational investor amplifies every advantage. Time also rewards discipline. All the principles we have discussed, competence, margin of safety, slow thinking, and emotional control, show their full strength when combined with patience. Without time, even the best judgment cannot achieve maximum results. With time, even modest insights compound into lasting wealth. The irrational mind fears waiting. It wants immediate gratification. It believes that delay is risk. But delay is often protection. The market may misprice assets for months or years. The rational investor uses this period to observe, learn, and act only when conditions align with reason. History is full of examples of time revealing the truth. Stocks, businesses, and investments that appeared dull or risky eventually produced enormous returns. The impatient missed the gains. The patient prospered. The rational mind embraces this lesson, understanding that patience is not passive. It is an active strategy rooted in understanding and foresight. Time also magnifies mistakes when principles are ignored. Impulsive decisions, emotional reactions, and ignorance of value become more costly as years pass. Conversely, consistent application of rational principles compounds advantages. The longer you apply logic, discipline, and careful analysis, the more inevitable success becomes. Even losses have value over time if approached rationally. A temporary setback provides experience, teaches humility, and strengthens judgment. Time turns these lessons into wisdom. Without the element of time, these lessons would feel painful and final. With time, they become stepping stones. Time is also a shield against uncertainty. The market is unpredictable. No one can forecast daily movements or sudden events. But over years, patterns emerge, businesses grow, and the real value of assets becomes clearer. A rational investor leverages this natural process instead of fighting it. The greatest investors understand that patience is not passive waiting, but active observation. It is the discipline to hold, the wisdom to adjust when necessary, and the clarity to see opportunities others overlook. Every decision made today compounds with every decision tomorrow. Time multiplies both success and error, depending on the choices made. The lesson is simple. Start early. Be patient. Trust in rational principles. Do not let short-term swings distract you. Time is the canvas upon which wealth is painted. The longer the horizon, the more detailed and powerful the picture becomes. In the next chapter, we will explore learning from loss. Even with patience and rational thought, setbacks occur. Understanding them transforms mistakes into wisdom and failure into growth. Chapter 10. Learning from loss. No investor is immune to loss. Mistakes are inevitable. Markets are unpredictable. Even the most rational and disciplined mind will encounter setbacks. The question is not whether loss will occur, but how you respond when it does. A rational investor treats loss as a teacher. It is an opportunity to learn, not a reason for despair. Every mistake carries a lesson about process, judgment, or emotion. Ignoring the lesson guarantees repetition. Embracing it strengthens the mind and improves future decisions. Losses often expose hidden weaknesses. Perhaps the circle of competence was overstretched. Perhaps the margin of safety was ignored. Perhaps emotions were allowed to influence decisions. By analyzing loss carefully, the rational investor uncovers these vulnerabilities. This is not self-criticism. It is self-improvement. One of the most important lessons from loss is humility. Markets are vast and complex. Even the best minds cannot control every outcome. Acknowledging this reality reduces overconfidence. It prevents reckless decisions born from arrogance. Loss also reinforces the value of patience. When prices fall sharply, the emotional response is often panic. The rational mind resists this urge. It asks, is this a permanent decline or a temporary fluctuation? Does this change the intrinsic value or just the market perception? By analyzing calmly, mistakes can be corrected without panic. Another lesson is risk awareness. Loss teaches that no opportunity is risk-free. It reminds the investor to maintain a cushion, to respect uncertainty, and to act only when probability favors him. Every setback reinforces the importance of mental models, competence, and discipline. The rational investor also recognizes that loss is not personal. It is a natural part of market activity. Treating it as a failure of character leads to fear and hesitation. Treating it as a natural outcome leads to reflection and growth. Emotions are observed but not allowed to dictate action. Learning from loss also requires honesty. You must identify the root cause without excuses. Was it a miscalculation? A premature decision? Overconfidence? Haste? Once the source is understood, the process can be improved. Losses can also be reframed as investment in experience. Every setback teaches patience, discipline, and judgment. It strengthens intuition that cannot be gained from success alone. The rational mind values these lessons more than temporary gains. Another key insight is the avoidance of repetition. Rational investors track their mistakes. They develop rules to prevent similar errors in the future. This transforms loss into an asset rather than a liability. Experience becomes a guide, not a burden. Loss also tests emotional control. Fear and regret are powerful forces. A rational mind observes these feelings without surrendering to them. It maintains calm, reflecting on what is known rather than what is feared. This emotional mastery is as valuable as any financial principle. Ultimately, learning from loss is about perspective. Temporary setbacks are not permanent. They can sharpen the mind, improve judgment, and reinforce rational habits. Wealth built with awareness of mistakes is stronger than wealth built from luck alone. In the next chapter, we will explore the art of independent thinking. Even after mastering principles, avoiding emotional traps, and learning from loss, the rational investor must develop the courage to think differently from the crowd. Chapter 11. The Art of Independent Thinking. Independent thinking is the hallmark of a rational investor. It is the courage to see what others miss, to question popular opinion, and to act based on reason rather than consensus. The world is full of noise. Most people follow the crowd, reacting to emotion and trend. The rational investor steps back and observes. Thinking independently begins with skepticism. Do not accept assumptions blindly. Do not follow advice without understanding. Every investment idea must be examined through your own lens of competence, analysis, and mental models. This does not mean distrust of others, but trust in your reasoning. The market often punishes conformity. When everyone acts in the same way, prices are distorted. Opportunities appear in the gaps created by mass behavior. A rational mind sees these gaps. It asks, why are others wrong? What facts are they missing? Where is the real value hidden? Independent thinking is strengthened by knowledge. Reading, observation, and study build the foundation. Without understanding, independent thought can become arrogance or guesswork. With understanding, it becomes clarity, confidence, and insight. Another aspect of independent thinking is patience. Most investors react immediately to headlines, trends, and rumors. Independent minds resist this pressure. They wait for alignment between insight and opportunity. They understand that acting without reason is no different from gambling. The rational investor also balances independence with humility. Being independent does not mean assuming infallibility. It means questioning, analyzing, and acting only when evidence supports it. It means knowing the limits of your knowledge and staying within the circle of competence. Groupthink is one of the greatest dangers to rational thought. Humans are social creatures. We seek approval, comfort, and validation from others. In investing, this leads to copying decisions, chasing trends, and ignoring risk. Independent thinking resists this pull. It maintains focus on fundamentals rather than popularity. Independent thinking also requires courage. It may feel uncomfortable to disagree with the majority. It may invite criticism or skepticism. But the rational mind values truth over approval. Long-term results follow insight, not applause. The rational investor cultivates independent thinking through reflection. He questions his own assumptions regularly. He tests ideas against evidence, not emotion. He welcomes dissenting opinions to challenge bias. Through this process, decisions become sharper, more rational, and less vulnerable to error. Another advantage of independent thought is resilience. The market will fluctuate. Others may panic or celebrate irrationally. By relying on independent judgment, you are less swayed by volatility. You stay grounded in reality rather than perception. Independent thinking also allows for creativity. It enables the discovery of opportunities that others ignore. It encourages innovation in approach, strategy, and analysis. The rational mind sees possibilities where conformity sees only risk. Finally, independent thinking reinforces all prior principles. Slow thinking, discipline, emotional control, understanding value, competence, and the margin of safety all work better when guided by a rational, independent mind. It transforms knowledge into action and insight into advantage. In the next chapter, we will explore the psychology of patience. Even with independence, emotion and impatience can influence action. Understanding how to cultivate patience ensures that reason is applied consistently and effectively over time. Chapter 12. The Psychology of Patience. Patience is not passive. It is an active skill that requires awareness, discipline, and trust in process. In investing, impatience is one of the most common mistakes. People want results quickly. They chase trends. They react to noise. The rational investor understands that lasting success takes time. The psychology of patience begins with understanding human nature. Humans are wired for instant gratification. We want to see results, rewards, and confirmation immediately. The market, however, operates on its own timeline. Price does not always reflect value instantly. It can take months or years for fundamentals to be recognized. Patience requires emotional control. When the market fluctuates, fear and greed can tempt impulsive decisions. A patient investor observes these feelings without surrendering to them. He reminds himself that temporary swings are irrelevant to intrinsic value. He waits calmly for conditions to align with reason. Another key aspect is focus on process, not outcome. Patience is built through disciplined adherence to principles. By following mental models, respecting competence, and maintaining a margin of safety, the investor ensures that waiting is productive rather than passive. Each day of observation and reflection compounds advantages. Impatience often stems from comparison. People look at what others are earning or doing. They compare gains, losses, and successes. This comparison creates pressure to act. The rational investor ignores this. He focuses on his own circle of competence, his own analysis, and his own timeline. Time amplifies results, but only when patience is applied consistently. Compounding works best when decisions are maintained over long periods. Short-term impatience can destroy long-term advantage. The market rewards the investor who can wait intelligently. Patience is also linked to humility. It requires acknowledging that you cannot control all outcomes. You cannot force the market to align with your expectations immediately. You can, however, control your actions, analysis, and preparation. This distinction creates calm and clarity. Another psychological element is expectation management. Patience grows when you accept that markets do not move in straight lines. Ups and downs are natural. Volatility is not a signal to act impulsively, but an opportunity to observe, learn, and wait. Understanding this helps maintain focus and prevents emotional errors. The rational investor uses waiting time to gather information. He studies businesses, industries, and economic trends. He refines his analysis and strengthens his decision-making process. Patience is not emptiness. It is preparation, observation, and readiness to act when evidence aligns with judgment. Patience also reduces regret. Impulsive actions often lead to mistakes that haunt the mind. Waiting allows rational analysis to guide choices. It transforms anxiety into understanding, impulsiveness into strategy. Finally, patience is cumulative. Each patient decision reinforces the next. Each disciplined action strengthens confidence in process over emotion. Over years, this consistency compounds into wealth, knowledge, and wisdom. The next chapter will explore rational decision-making under uncertainty. Even with patience, life and markets are unpredictable. Learning to make reasoned choices when outcomes are uncertain is essential for long-term success. Chapter 13. Rational Decision-Making. Under Uncertainty. Uncertainty is the constant companion of every investor. No one can predict the future with complete accuracy. Economic changes, market fluctuations, political events, and human behavior all create unpredictability. The rational investor does not fear uncertainty. He manages it. Rational decision-making under uncertainty begins with acceptance. You must acknowledge that outcomes are never guaranteed. No matter how careful the analysis, surprises will occur. This acceptance does not breed passivity. It breeds preparedness. Probability thinking is essential. Every decision carries a range of possible outcomes. Instead of imagining a single result, the rational mind evaluates likelihoods. It asks, what is most probable? What is less likely? What are the consequences of each scenario? This approach transforms uncertainty from chaos into manageable analysis. Mental models become powerful tools under uncertainty. The circle of competence ensures you act where knowledge is strongest. The margin of safety cushions against mistakes. Discipline prevents impulsive reactions to temporary events. Together, these principles turn unknowns into calculated opportunities. A rational investor avoids overconfidence. Predicting exact outcomes is impossible. Overconfidence leads to reckless bets and emotional stress. Instead, the rational mind uses probabilities and safeguards to guide decisions. Success comes not from certainty, but from consistently making decisions that are likely to produce positive results over time. Scenario planning is another technique. By imagining different outcomes and their impact, you prepare for the unexpected. You define actions for worst case, average case, and best case scenarios. This preparation reduces fear and prevents rash decisions during market turbulence. Emotions amplify uncertainty. Fear exaggerates risk. Greed inflates reward. The rational investor observes feelings without surrendering to them. He relies on logic, data, and frameworks to guide action. This allows clear decisions even when outcomes are unknown. Risk is not avoided but managed. Uncertainty is inherent, but losses can be minimized by careful evaluation, diversification, and prudence. Every decision is weighed against potential reward, probability, and downside protection. This disciplined approach separates rational investors from those who gamble blindly. Decision-making under uncertainty also involves patience. Immediate results are rare. The rational mind waits for alignment between knowledge, opportunity, and market conditions. It acts decisively when preparation meets chance. Waiting is not inaction, it is strategic timing. Another element is learning from feedback. Every outcome, whether favorable or not, provides information. The rational investor reflects on results, identifies errors in analysis, and refines strategies. Uncertainty becomes a teacher rather than a threat. Independent thinking complements rational decision-making. Crowds react to news, trends, and emotion. Rational investors analyze instead of following. They recognize that uncertainty does not justify conformity. Insight emerges from careful thought, not impulse. Ultimately, rational decision-making under uncertainty is about probability, preparation, and discipline. It is about acting when conditions favor reason, not emotion. It is about using knowledge to navigate a world that cannot be predicted with certainty. It is the skill that transforms risk into opportunity and chaos into manageable steps. The next chapter will explore the power of reflection and continuous learning. Even after mastering rational decision-making, ongoing observation and learning ensure that the mind remains sharp, adaptable, and prepared for every challenge. Chapter 14: The Power of Reflection and Continuous Learning. The mind of a rational investor is never static. Even after mastering principles, emotions, patience, and competence, growth continues through reflection and learning. Reflection is the mirror of experience. Learning is the engine of improvement. Together, they create resilience, insight, and long-term advantage. Reflection begins with observation. Every action, decision, and outcome carries lessons. The rational investor reviews successes and mistakes alike. He asks, why did this decision work? Why did this investment fail? What factors were overlooked or misjudged? This continuous questioning turns experience into wisdom. Mistakes are not shameful. They are opportunities to refine thinking. By analyzing errors, you strengthen discipline, enhance judgment, and reduce the chance of repetition. Successes are also examined. Understanding why a decision succeeded ensures that sound principles are reinforced rather than attributed to luck. Continuous learning is equally important. Markets evolve, industries shift, economic conditions change. A rational mind adapts by absorbing new information, updating mental models, and expanding competence. Learning is deliberate, focused, and guided by curiosity rather than fear or trend following. Reading, observing, and questioning form the core of this process. Historical analysis provides context. Studying businesses, markets, and human behavior offers insight. Every experience becomes raw material for improvement. The mind trained in reflection and learning becomes sharper with each cycle. The process also requires humility. No matter how much is known, there is always more to learn. Acknowledging gaps in understanding opens doors to growth. Arrogance, overconfidence, or assumption of mastery stifles insight. The rational mind remains curious, receptive, and disciplined. Reflection is enhanced by documentation. Recording decisions, rationales, and outcomes creates a feedback loop. Future choices are informed by past experiences rather than memory alone. This prevents repetition of mistakes and strengthens the application of principles under diverse conditions. Continuous learning is reinforced by experimentation. Testing ideas within the circle of competence, applying mental models, and observing outcomes expands understanding. Even failed experiments provide clarity. Every iteration adds to skill, judgment, and confidence. Another benefit of reflection and learning is emotional growth. Understanding past emotional responses reduces susceptibility to fear, greed, or impatience. The mind becomes aware of triggers, allowing reason to guide action instead of impulse. Learning is also strategic. It prioritizes depth over breadth, focusing on areas of competence and relevance. It is guided by purpose rather than curiosity alone. Rational learning is not random accumulation of knowledge. It is deliberate strengthening of decision-making capacity. Time multiplies the effect of reflection and learning. The longer you engage in this process, the more refined your understanding, the more disciplined your decisions, and the more resilient your approach becomes. Wisdom compounds like capital, quietly yet powerfully. Ultimately, reflection and continuous learning transform experience into insight. They convert mistakes into advantage and observation into opportunity. The rational investor grows not only in wealth, but in skill, judgment, and understanding. In the next chapter, we will explore the role of ethics in rational investing. Even the most logical decisions require a moral framework to ensure trust, sustainability, and integrity in markets and relationships. Chapter 15. The role of ethics in rational investing. Rational investing is not just about numbers, analysis, or strategy. It is also about integrity, trust, and ethical decision-making. Markets operate on confidence. When ethics are compromised, confidence erodes and risk increases. The rational investor understands that long-term success depends on doing the right thing, not just the profitable thing. Ethics begins with honesty. Accurate evaluation of investments requires truthful assessment. Exaggeration, misrepresentation, or self-deception clouds judgment. By maintaining honesty, the rational investor ensures clarity in decision-making. Transparency is another principle. Whether dealing with partners, clients, or stakeholders, openness builds trust. Trust reduces friction, creates opportunities, and protects reputation. Without trust, even rational decisions can fail due to miscommunication or loss of confidence. Ethical investing also involves fairness. It requires avoiding exploitation, deception, or manipulation. Opportunities that seem profitable at the expense of others often carry hidden risks. The rational mind recognizes that short-term gain from unethical actions can lead to long-term loss. The market punishes unethical behavior in subtle ways. Reputation damage, legal consequences, and relational breakdowns can outweigh any immediate profit. Rational investors avoid these pitfalls by adhering to a consistent ethical framework. Ethics also supports rational decision-making by reducing stress. Decisions made with integrity create alignment between action and conscience. This reduces cognitive dissonance, emotional conflict, and impulsive reactions. Calm and clarity flourish when ethics guide choice. Another key point is responsibility. Rational investors recognize the impact of their decisions on others, including employees, clients, and society. They do not separate profit from consequence. Long-term rationality requires considering broader implications. Ethics reinforces the principles of patience, reflection, and independent thinking. It discourages shortcuts, hype-driven actions, and opportunistic behavior. It strengthens discipline because moral considerations create additional guardrails against impulsive or reckless behavior. Sustainability is part of ethical investing. Rational decisions consider long-term viability rather than temporary gain. Ethical investing aligns with enduring value creation rather than exploitation of fleeting trends. This alignment ensures that profits are not just immediate, but sustainable. Ethics also influences mental models. Decision-making frameworks are strengthened when moral principles are embedded. Risk, probability, and analysis are not purely mechanical. They are guided by values that maintain integrity and trustworthiness. Ultimately, ethics is not a constraint. It is an enhancer of rational investing. It creates credibility, reduces hidden risk, and ensures that decisions withstand scrutiny over time. By combining logic, discipline, and morality, the rational investor achieves outcomes that are profitable, reliable, and principled. The next chapter, and the final one, will explore synthesis, becoming a rational investor. Here, all principles learned throughout the book, mental models, competence, margin of safety, patience, ethics, and reflection, are brought together into a cohesive framework for lifelong rational investing. Chapter 16. Synthesis. Becoming a rational investor. Becoming a rational investor is not a single action. It is the culmination of understanding, discipline, patience, and reflection. It is the integration of principles learned over time into a cohesive approach to thinking, deciding, and acting in markets. The rational investor begins with mental models. He applies frameworks for thinking, reasoning, and analyzing information. These models filter noise from signal, emotion from fact, and speculation from reason. They create clarity in complex and uncertain environments. Competence guides action. By focusing on areas of knowledge and experience, the rational investor avoids mistakes outside his circle. He recognizes limits, leverages strengths, and constantly expands understanding through deliberate learning. The margin of safety protects capital and mind. It is a cushion that allows the rational investor to act decisively while mitigating the impact of errors. It transforms uncertainty from threat into manageable risk. Patience is the engine that powers compounding. The rational mind resists the allure of instant results, embracing time as a partner. It understands that wealth, wisdom, and insight grow quietly through consistent application of principles. Independent thinking ensures that decisions are guided by evidence and reason rather than crowd behavior. It allows creativity, insight, and opportunity to emerge where conformity sees risk. Ethical principles reinforce trust, integrity, and sustainability, aligning profit with morality. Reflection and continuous learning are the fuel of improvement. Every success, failure, and observation strengthens judgment. The rational investor records, analyzes, and refines, ensuring that mistakes become lessons and knowledge compounds over time. Decision-making under uncertainty combines all these principles. By applying probability, preparation, and calm analysis, the rational investor navigates unpredictable markets without fear or recklessness. He converts risk into opportunity and complexity into clarity. Synthesis is not theoretical. It is practical action applied consistently over years. It is the mindset that transforms information into insight, analysis into action, and patience into wealth. It is the ability to act rationally in an irrational world. The rational investor does not chase every opportunity. He does not react to every trend or headline. He observes, evaluates, and decides based on principles, not impulse. This disciplined approach multiplies advantage, reduces mistakes, and ensures long-term results. Ultimately, becoming a rational investor is a journey of growth. It is the continuous alignment of thought, action, and principle. It requires humility, courage, discipline, and curiosity. It is a lifelong practice rather than a single achievement. By synthesizing mental models, competence, margin of safety, patience, independent thinking, ethics, reflection, and learning, the rational investor achieves clarity in chaos, stability in uncertainty, and opportunity in risk. He transforms complexity into reason, fear into calm, and possibility into measurable progress. This is the path to lasting success. It is not flashy, but it is reliable. It is not fast, but it endures. It is the art of thinking, not just the act of buying. Conclusion: investing is more than buying and selling. It is a discipline of the mind, a practice of rational thought, and a journey of continuous learning. The principles outlined in this book are not shortcuts or magic formulas. They are tools to think clearly, act wisely, and navigate uncertainty with calm and confidence. Mental models shape how you understand the world. They help you filter noise, focus on what matters, and avoid common errors. The circle of competence reminds you to act where knowledge is strongest. The margin of safety protects your capital and mind from mistakes. Patience allows time to work its magic. Compounding, observation, and disciplined action transform small steps into lasting results. Independent thinking ensures your choices are guided by reason, not the crowd. Reflection and continuous learning turn experience into insight. Ethics and integrity guide decisions, creating trust, credibility, and sustainable success. Losses are teachers, not punishments. Uncertainty is a companion, not an enemy. By embracing these realities, the rational investor acts with clarity rather than fear, with discipline rather than impulse. Ultimately, the rational investor seeks to think, not just to act. He values knowledge over speculation, preparation over luck, and principle over popularity. Success is not measured by instant gains, but by consistency, wisdom, and the ability to navigate markets over time. This is a lifelong practice. There is no final achievement, only continuous growth. By integrating mental models, competence, safety, patience, independent thinking, ethics, reflection, and learning, you transform investing into a rational, deliberate, and sustainable pursuit. The rational investor does not chase every opportunity. He waits. He observes. He acts only when reason aligns with chance. And in this patient, disciplined, and principled approach, lasting wealth and enduring understanding are created. Investing is not about what to buy. It is about how to think. Master your mind, follow your principles, and the markets will reward clarity, patience, and reason.